Let me share something with you that most investors never learn until it is too late. Recessions do not destroy all wealth equally. While some sectors get decimated, losing 50, 60, even 70% of their value. Other sectors actually thrive. They grow revenues, they expand market share, they increase dividends. Their stock prices hold steady or even rise while everything else is collapsing. Understanding which sectors thrive in recessions is not just academic knowledge. It is the difference between watching your portfolio get destroyed and watching it hold firm while others panic. It is the difference between being forced to sell at the bottom and having the stability to buy when opportunities emerge. It is the difference between delaying retirement by a decade and staying on track with your financial goals. I have spent over 40 years in finance. I have navigated multiple recessions, including some that nearly brought down the global financial system. I have seen which companies survive and which ones fail. I have seen which sectors prosper and which ones collapse. And I am going to share that knowledge with you today. There are only 3 sectors that consistently thrive during recessions. Not survive. Thrive. These are sectors where demand remains strong regardless of economic conditions. Sectors where companies have pricing power even when consumers are cutting back. Sectors where the businesses are so essential that people cannot stop using them, no matter how bad things get. Before I reveal these 3 sectors, let me explain why most sectors struggle during recessions, because understanding the dynamics will help you understand why these 3 are different. During a recession, consumer spending contracts, people lose jobs. Those who keep their jobs worry about losing them. Households cut back on discretionary purchases. They delay buying new cars. They postpone home renovations. They skip vacations. They eat out less frequently. Any business that depends on discretionary spending sees revenues decline, often dramatically. Business spending also contracts. Companies cut capital expenditures. They delay expansion plans. They reduce inventory. They lay off workers. Any business that sells to other businesses faces declining demand as their customers pull back. Credit becomes harder to obtain. Banks tighten lending standards. Interest rates may rise as risk premiums increase. Companies that depend on borrowing to fund operations face higher costs or cannot access credit at all. Highly leveraged companies may default entirely. Confidence collapses. Even people with secure jobs and stable finances become cautious. They save more and spend less. They avoid major commitments. This decline in confidence becomes self-reinforcing as reduced spending leads to more layoffs, which leads to even less confidence. In this environment, most businesses struggle. Their revenues decline, their profits evaporate, their stock prices fall. This is the normal recession playbook that affects the majority of the economy. But some sectors are different. Some sectors have characteristics that insulate them from these dynamics or even cause them to benefit. Let me tell you about the 3 sectors that thrive when everything else is struggling. The first sector that thrives in recessions is healthcare. People get sick regardless of the economy. They need medications regardless of whether the stock market is up or down. They require surgeries regardless of the unemployment rate. The demand for healthcare is not discretionary. It is essential. This essential nature of demand creates remarkable stability for healthcare companies during recessions. While consumer discretionary companies see revenues fall 20 or 30%, healthcare companies often see revenues remain flat or even grow. The demographic tailwinds of an aging population continue regardless of economic conditions. In fact, during recessions, stress-related health issues often increase, creating additional demand. Let me be specific about which parts of healthcare thrive during recessions. Pharmaceutical companies with diversified drug portfolios are extremely resilient. People do not stop taking their blood pressure medication because the economy is weak. They do not skip their cancer treatment because unemployment is rising. The demand for established medications is inelastic, meaning it does not change significantly with economic conditions. The large pharmaceutical companies have additional advantages. They have strong balance sheets with minimal debt. They generate enormous free cash flow that funds dividends and research. They have pricing power because their products are protected by patents and face limited competition. They have global diversification that reduces dependence on any single market. During the 2008 financial crisis, while the S&P 500 fell over 50%, large pharmaceutical companies held up remarkably well. Some declined modestly, in line with overall market fear, but their fundamental business performance remained strong. They continued paying and raising dividends, they continued generating cash, and they recovered quickly when the crisis passed. Medical device companies also thrive during recessions. People still need pacemakers, artificial joints, and surgical equipment regardless of economic conditions. Hospitals cannot defer these purchases because patients need care. The demand is tied to demographics and medical necessity rather than economic cycles. Healthcare services companies benefit from the same dynamics. Hospitals, clinics, and outpatient facilities see stable demand because people continue getting sick. Laboratory companies that perform diagnostic tests see steady volumes. Healthcare staffing companies may actually see increased demand as healthcare facilities need flexible labor solutions. Healthcare real estate is another resilient category. Medical office buildings, hospitals, and senior living facilities have tenants with stable, often government-supported revenue streams. The leases are long-term. The tenants rarely default because healthcare organizations prioritize their physical facilities. Now, I want to be nuanced here. Not all healthcare is equally recession-resistant. Elective procedures like cosmetic surgery do decline during recessions because people can postpone them. Healthcare companies with heavy debt loads can struggle if credit markets seize up. Smaller biotechnology companies without approved drugs may fail if they cannot raise capital to fund research. But the core of the healthcare sector, the large pharmaceutical companies, the established medical device makers, the essential healthcare services, these thrive. The investment implications are clear. During a recession, you want exposure to healthcare. Large pharmaceutical companies with diversified product lines and strong balance sheets. Medical device companies with essential products. Healthcare REITs with quality tenants. These holdings will provide stability while other sectors collapse. The dividend income from healthcare companies is particularly valuable during recessions. Many large pharmaceutical companies have paid dividends for decades. They have increased those dividends consistently. During recessions, while other companies cut or eliminate dividends, healthcare companies typically maintain or increase them. This income provides cash flow when you need it most. The second sector that thrives in recessions is consumer staples. Consumer staples are the products that people buy regularly regardless of economic conditions. Food, beverages, household products, personal care items. People do not stop eating when the economy is weak. They do not stop washing their clothes or brushing their teeth. The demand for these essential products is remarkably stable. Think about your own behavior. If you lost your job tomorrow, what would you cut from your spending? You might cancel your vacation. You might postpone buying a new car. You might eat out less frequently. But would you stop buying groceries? Would you stop buying soap and toothpaste? Would you stop buying cleaning supplies for your home? Of course not. These are necessities. This is why consumer staples companies are so resilient during recessions. Their revenues remain stable because people keep buying their products. In fact, During recessions, consumer staples companies often gain market share as consumers trade down from expensive brands to more affordable options, many of which are made by the same large consumer staples companies. Let me be specific about which types of consumer staples companies thrive. Packaged food companies see stable demand regardless of economic conditions. People need to eat during recessions. They may actually eat more packaged food at home as they reduce restaurant spending. The major packaged food companies have strong brands that command consumer loyalty. They have distribution networks that reach every grocery store. They have pricing power that protects margins. Beverage companies, particularly those with strong brands, are extremely resilient. People continue drinking their favorite beverages, regardless of the economy. Soft drinks, coffee, and other beverages are affordable indulgences that people do not give up, even when cutting back elsewhere. The major beverage companies have some of the most valuable brands in the world and generate enormous cash flows. Household products companies sell items that people simply cannot do without. Cleaning supplies, paper products, laundry detergent, the demand is constant because households need these products to function. The major household products companies have dominant market positions and generate consistent earnings through every economic cycle. Personal care companies sell products that are embedded in daily routines: shampoo, soap, deodorant, skincare. People do not stop taking care of themselves during recessions. They might trade down to less expensive brands, but they keep buying. The companies that make these products see stable volumes regardless of economic conditions. Tobacco companies, while facing long-term secular decline in developed markets, are remarkably recession resistant. Smokers continue smoking during recessions. The addiction creates demand that is almost completely inelastic. The major tobacco companies generate enormous cash flows and pay high dividends. Retail grocery chains benefit during recessions as people shift spending from restaurants to home cooking. While other retailers struggle with declining foot traffic, grocery stores see stable or increasing visits. The essential nature of food creates reliable demand regardless of economic conditions. The financial characteristics of consumer staples companies make them particularly attractive during recessions. They typically have strong balance sheets with manageable debt levels. They generate consistent free cash flow that funds dividends. They have pricing power because their brands are trusted and their products are essential. They have global diversification that reduces dependence on any single market. The dividend income from consumer staples companies is reliable during recessions. Many of these companies have paid dividends for 50, 75, even 100 consecutive years. They have increased dividends for decades in a row during the 2008 financial crisis. While financial companies slashed dividends and industrial companies suspended them, consumer staples companies continued paying and raising dividends. That income stability is invaluable during turbulent times. The stock price stability of consumer staples companies provides peace of mind during recessions. While the overall market may fall 40 or 50%, consumer staples stocks typically fall much less. During the 2008 crisis, consumer staples as a sector declined about 25% compared to over 50% for the overall market. That relative stability helps you sleep at night and prevents panic selling at the worst time. The third sector that thrives in recessions is utilities. Utilities provide essential services that people cannot live without. Electricity, natural gas, water, these are not optional purchases. People do not cancel their electricity service because the economy is weak. They do not stop using water because they are worried about their job. The demand is as close to guaranteed as anything in the economy. This essential demand creates remarkable stability for utility companies. Their revenues barely budge during recessions. while other companies see sales decline 20 or 30%. Utilities might see a decline of 2 or 3%, mostly from reduced industrial usage. The residential and commercial demand remains rock solid because people need power and water to live and work. The regulatory structure of utilities adds another layer of stability. Most utilities operate as regulated monopolies. They are the only provider in their service territory. Regulators allow them to earn a reasonable return on their invested capital. This regulated model produces predictable earnings that do not fluctuate with economic cycles. Let me be specific about why utilities thrive during recessions. Electric utilities have captive customers who cannot switch providers. Every home and business needs electricity. The demand is essentially non-negotiable. During recessions, residential electricity usage may actually increase as more people work from home or spend time at home rather than going out. Industrial usage declines somewhat, but this is typically a small portion of total demand. The regulated return model means electric utilities earn consistent profits regardless of the economy. Regulators set rates that allow the utility to recover its costs, plus a reasonable return on capital. This model eliminates the earnings volatility that affects other industries. Natural gas utilities benefit from similar dynamics. People need heat in the winter. They need gas for cooking and water heating. The demand is essential and non-discretionary. Regulated returns provide stability and predictability. Water utilities are perhaps the most essential of all. No one stops using water, regardless of economic conditions. The demand is absolutely inelastic. Water utilities are typically regulated monopolies with guaranteed returns. They are about as recession-proof as any business can be. The financial characteristics of utilities make them ideal recession holdings. They have predictable cash flows that support consistent dividends. Many utilities have paid dividends for over a century. They have increased dividends for decades in a row. The yields are typically higher than the market average, providing income when you need it. The balance sheets of utilities are typically conservative. Yes, they carry significant debt to fund capital investments, but the regulated return model means they can service that debt reliably. The debt is secured by essential infrastructure that holds its value. The risk of financial distress is minimal for well-run utilities. The stock price stability of utilities during recessions is remarkable. While the overall market may collapse, utilities typically hold their value during the 2008 crisis. The utility sector declined about 30% compared to over 50% for the overall market. This relative stability reflects the essential nature of demand and the predictable earnings model. Some utilities are benefiting from the secular trend toward renewable energy and electrification. Electric utilities that are investing in wind, solar, and grid modernization are seeing rate-based growth that drives earnings growth. This growth, combined with recession resistance, makes certain utilities particularly attractive. Now let me explain how to implement a recession-resistant portfolio focused on these three sectors. The first principle is diversification within sectors. Do not put all your eggs in one basket, even within recession. Resistant sectors own multiple healthcare companies across pharmaceuticals, medical devices, and healthcare services. Own multiple consumer staples companies across food, beverages, and household products. Own multiple utilities across electric, gas, and water. This diversification protects against company-specific problems while maintaining sector exposure. The second principle is quality over yield. Some companies in these sectors offer high dividend yields because their businesses are struggling or their dividends are at risk. Do not chase yield. Focus on companies with strong balance sheets, consistent earnings, and sustainable dividends. It is better to own a company yielding 3% with a secure dividend than a company yielding 7% with a dividend that might be cut. The third principle is valuation awareness. Even recession-resistant companies can be overpriced. When everyone recognizes that a sector is defensive, money flows in and valuations rise. Be willing to pay a fair price for quality, but do not overpay just because a company is in a defensive sector. The best time to buy defensive stocks is before everyone else realizes they need them. The fourth principle is balance with the rest of your portfolio. These three sectors should be a significant portion of your equity allocation, but they should not be everything. When the recession ends and growth resumes, cyclical sectors will outperform. Having some exposure to other sectors positions you to participate in the recovery. The goal is resilience, not complete isolation from the broader market. Let me give you specific guidance on allocation for someone who is concerned about recession risk. Having 40 to 50% of equity exposure in these three defensive sectors is reasonable. This might be split roughly equally among healthcare, consumer staples, and utilities, or tilted toward whichever sector you find most attractive. The remaining 50 to 60% can be in other sectors with a tilt toward quality and dividend, paying companies throughout for someone who is more conservative, perhaps approaching retirement or already retired. The allocation to defensive sectors could be even higher. 60% or more of equity exposure in healthcare, consumer staples, and utilities would provide significant downside protection, combined with a meaningful allocation to bonds and cash. This creates a portfolio that can weather severe recessions without catastrophic losses. The specific investment vehicles depend on your preference and expertise. You can buy individual stocks in each sector if you are willing to do the research and monitoring. You can use sector-specific exchange, traded funds that provide diversified exposure at low cost. You can use dividend-focused funds that naturally tilt toward these defensive sectors. Each approach has trade-offs, but all can achieve the goal of recession-resistant equity exposure. Let me address some objections you might have. You might be thinking that these defensive sectors will underperform when the economy is growing. That is true. When the economy is strong and risk appetite is high, cyclical sectors like technology, industrials, and consumer discretionary typically outperform. Defensive sectors lag because their stable earnings growth cannot match the rapid growth of cyclical companies. But here is the key insight. You do not need to maximize returns when times are good. You need to avoid catastrophic losses when times are bad. The math of compounding means that avoiding large losses is more important than capturing every bit of upside. A portfolio that returns 8% in good years and falls 10% in bad years will outperform a portfolio that returns 15% in good years and falls 40% in bad years. The stability of defensive sectors provides this downside protection. You might also be thinking that you can time the market moving to defensive sectors before recessions and back to cyclical sectors afterward. Let me be direct with you. You cannot reliably time the market. No one can. Recessions are only officially declared after they have already started. By the time you know a recession is coming, prices have already adjusted. Trying to time sector rotation is a recipe for buying high and selling low. The better approach is to maintain consistent exposure to defensive sectors as a permanent part of your allocation. You will underperform somewhat during strong bull markets, but you will outperform dramatically during bear markets and recessions. Over a full cycle, the results will be competitive with more aggressive approaches, but with much less volatility and stress. You might also wonder whether these sectors will be affected by specific risks. Healthcare faces regulatory risk around drug pricing and healthcare policy. Consumer staples faces competition from private label products and changing consumer preferences. Utilities faces risks from energy transition and regulatory changes. These risks are real and should be managed through diversification, but they do not eliminate the fundamental recession resistance of these sectors. Let me share some historical perspective on how these sectors performed during past recessions. During the 2008 financial crisis, the S&P 500 fell over 50% from peak to trough. Healthcare fell about 35%. Consumer staples fell about 25%. Utilities fell about 30%. All three sectors significantly outperformed the broader market, and all three recovered faster when the crisis ended. During the 2001 recession following the dot-com crash, the technology-heavy NASDAQ fell about 80%. The S&P 500 fell about 50%. Healthcare, consumer staples, and utilities all held up much better, with declines in the range of 20 to 30%. Investors who were concentrated in these defensive sectors avoided the worst of the carnage. During the 1990 recession, the pattern was similar. Cyclical sectors struggled, while defensive sectors held relatively steady. The dividend income from defensive holdings provided cash flow to meet expenses or reinvest at lower prices. This pattern repeats in recession after recession. The specific details vary, but the fundamental dynamic remains the same. Sectors with essential, non-discretionary demand hold up better than sectors with discretionary demand. Healthcare, consumer staples, and utilities consistently fall less and recover faster than the overall market. Let me also discuss how dividends from these sectors provide particular value during recessions. During recessions, many companies cut or eliminate dividends. Industrial companies whose earnings have collapsed cannot maintain dividend payments. Financial companies facing credit losses need to preserve capital. Even companies that could afford to maintain dividends sometimes cut them to signal prudence to the market. But healthcare, consumer staples, and utility companies typically maintain and increase dividends during recessions. Their stable earnings support consistent payouts. Their conservative balance sheets provide flexibility. Their management teams understand that income-seeking investors depend on these dividends and prioritize maintaining them. This dividend stability matters for several reasons. First, the income itself is valuable. If you are retired and living on dividend income, you need that income to continue regardless of market conditions. Defensive sector dividends provide that reliability. Second, stable dividends support stock prices. Companies that maintain dividends attract income-seeking investors even during market turmoil. This buying support limits price declines and speeds recovery. Third, reinvested dividends accelerate recovery. If you are reinvesting dividends rather than spending them, those reinvested dividends buy more shares when prices are low. This dollar cost averaging into low prices enhances long-term returns. Let me conclude with some thoughts on why this matters for your specific situation. If you are approaching retirement or already retired, you cannot afford a catastrophic loss. A 40 or 50% decline in your portfolio could devastate your retirement plans. You might have to delay retirement by years. You might have to dramatically reduce your standard of living. You might run out of money before you run out of life. Concentrating your equity exposure in healthcare, consumer staples, and utilities significantly reduces this risk. These sectors will still decline during recessions, but the declines will be more moderate. 20 or 30% is painful, but survivable. It is not catastrophic. If you are still working but want to reduce volatility, these sectors provide a middle ground between aggressive growth and complete safety. You maintain equity exposure and participate in long-term market growth, but with less downside risk than a portfolio concentrated in cyclical sectors. If you have a long time horizon and can truly stomach volatility, you might choose to maintain a more aggressive allocation. But even aggressive investors benefit from having some defensive exposure as ballast in their portfolio. The specific allocation depends on your circumstances, your risk tolerance, your income needs, and your time horizon. But for most investors, having significant exposure to healthcare, consumer staples, and utilities makes sense as a permanent part of the portfolio. Recessions are inevitable. They happen every 7 to 10 years on average. The next one could start tomorrow or could be years away, but it is coming. The question is not whether there will be another recession, but whether you will be prepared when it arrives. The three sectors I have shared with you today, healthcare, consumer staples, and utilities, have proven their recession resistance across decades of economic cycles. They will not make you rich quickly. They will not generate exciting returns during bull markets, but they will protect your wealth when protection matters most. They will let you sleep at night when others are panicking. They will keep you on track toward your financial goals regardless of what the economy does. That is the kind of investment I want in my portfolio. That is the kind of investment you should want in yours. Position yourself now before the next recession arrives. The time to prepare is when skies are clear, not when the storm is already upon you. These three sectors are where your money should be. Let me go deeper on each of these three sectors because understanding the specific dynamics will help you make better investment decisions. Starting with healthcare, let me explain the structural factors that make this sector recession resistant beyond just the essential nature of demand. The aging of the population creates a demographic tailwind that operates independently of economic cycles. Every day, thousands of Americans turn 65 and become eligible for Medicare. This cohort uses healthcare services at much higher rates than younger people. More doctor visits, more prescriptions, more surgeries, more hospitalizations. This demographic wave continues regardless of whether the economy is growing or shrinking. The innovation in healthcare creates new products and services that generate demand regardless of economic conditions, new drugs that treat previously untreatable conditions, new devices that enable less invasive procedures, new diagnostic tools that detect diseases earlier. This innovation creates new revenue streams that grow even during recessions as patients and providers adopt new technologies. The insurance structure of healthcare insulates demand from economic weakness. Most Americans have health insurance through their employers, through government programs like Medicare and Medicaid, or through the individual market. This insurance pays for most healthcare costs, so patients are not making healthcare decisions based purely on their personal financial situation. The demand is buffered by the insurance layer. The essential nature of many healthcare decisions means postponement is not an option. If you have cancer, you cannot wait until the economy improves to begin treatment. If you have a heart attack, you go to the hospital regardless of the unemployment rate. If you have a chronic condition that requires medication, you keep taking that medication. The urgency of healthcare decisions overrides economic concerns. Let me explain which specific types of healthcare companies are most attractive during recessions. Large diversified pharmaceutical companies are the backbone of recession-resistant healthcare investing. Companies with portfolios of established drugs across multiple therapeutic areas. These companies have predictable revenue from patent, protected medications. They have pipelines of new drugs that will replace revenues when patents expire. They have global operations that diversify geographic risk. They have strong balance sheets that support dividends through all economic conditions. The cash flow characteristics of pharmaceutical companies are exceptional. Once a drug is developed and approved, the manufacturing cost is typically a small fraction of the selling price. The gross margins are often 70 or 80%. This creates enormous operating leverage where stable revenues translate into stable and substantial profits. Medical device companies with essential products are also highly attractive. Pacemakers and defibrillators that keep hearts beating, artificial joints that restore mobility, surgical instruments that enable life-saving procedures. These products are not discretionary. Hospitals must have them to provide care. The demand persists regardless of economic conditions. Healthcare equipment and supplies companies benefit from similar dynamics. Hospital beds, monitoring equipment, surgical supplies, diagnostic instruments, healthcare facilities need these items to operate. They cannot defer purchases indefinitely, especially for consumable supplies that are used up in the course of providing care. Contract research organizations and contract manufacturing organizations serve the pharmaceutical industry and have steady demand. Drug development continues during recessions because pharmaceutical companies need to maintain their pipelines. The outsourced service providers that support this development have relatively stable revenues. Healthcare information technology companies are becoming essential to healthcare delivery, electronic health records, practice management systems, revenue cycle management. Healthcare providers depend on these systems to operate, and switching costs are high. Once a hospital or clinic implements a system, they rarely change providers. Let me also explain the dividend characteristics of healthcare companies that make them attractive for income. Seeking investors. Many large pharmaceutical companies have paid dividends for decades. They have increased those dividends annually for 25, 30, 40 years or more. This track record demonstrates commitment to returning capital to shareholders and ability to generate consistent cash flow. The payout ratios are typically conservative. Most large pharmaceutical companies pay out 40 to 60% of earnings as dividends, retaining the rest for research and development, acquisitions, and balance sheet strength. This conservatism provides a cushion during difficult periods. The dividend yields are often attractive compared to the broader market. Healthcare companies frequently yield 3 to 4% or more, providing meaningful income. This yield, combined with the stability of the payments, makes healthcare dividends particularly valuable during recessions. Now let me go deeper on consumer staples because this sector has nuances that affect investment decisions. The brand strength of major consumer staples companies creates competitive advantages that persist through economic cycles. Consumers trust these brands. They have used them for years or decades. They are reluctant to switch, even to save a few cents. This brand loyalty provides pricing power that protects margins during inflationary periods and demand stability during recessions. The distribution networks of major consumer staples companies are nearly impossible to replicate. These companies have relationships with every major retailer. Their products are on shelves in stores across the country and around the world. A new competitor would need years and billions of dollars to build comparable distribution. This creates barriers to entry that protect market positions. The economies of scale in consumer staples manufacturing are significant. The major companies produce billions of units across their product lines. They can spread fixed costs across enormous volumes. They can negotiate favorable terms with suppliers. They can invest in automation and efficiency. These scale advantages translate into cost advantages that smaller competitors cannot match. The diversification of major consumer staples companies across products and geographies reduces risk. A company that sells dozens of product categories is not dependent on any single product succeeding. A company that operates in dozens of countries is not dependent on any single economy growing. This diversification creates stability that single product or single market companies cannot achieve. Let me explain how consumer behavior during recessions actually benefits consumer staples companies. When households cut back during recessions, they often substitute home consumption for away from home consumption. Instead of eating at restaurants, they cook at home. Instead of going to movies, they watch television at home. Instead of traveling, they stay home. This substitution increases demand for food, beverages, and entertainment products consumed at home, many of which are made by consumer staples companies. The trading down phenomenon during recessions can benefit consumer staples companies. Consumers may switch from premium brands to mainstream brands or from mainstream brands to value brands. But many of these brands across the price spectrum are owned by the same large consumer staples companies. The company may lose sales of its premium products, but gain sales of its value products. The overall impact on the company is muted. Private label products, which are store brands sold by retailers, do gain share during recessions as price-conscious consumers seek savings. But the major consumer staples companies often manufacture private label products under contract for retailers. They may earn lower margins on private label than on their branded products, but they still earn something. The competitive threat from private label is real but often overstated. The innovation in consumer staples, while less dramatic than in healthcare or technology, creates new products that drive growth, new flavors, new formats, new categories, healthier alternatives, sustainable packaging. These innovations create reasons for consumers to try new products and for retailers to allocate shelf space. The major consumer staples companies have research and development capabilities that support continuous innovation. Let me explain the specific types of consumer staples companies that are most attractive during recessions. Packaged food companies with diversified portfolios across many categories are highly resilient. Breakfast cereals, snacks, condiments, frozen foods, baked goods. These companies have products that span the grocery store. They have brands that consumers know and trust. They have the scale and distribution to reach every market. Beverage companies with strong brand portfolios are extremely recession resistant. Soft drinks, juices, water, sports drinks, energy drinks, coffee, tea. People keep drinking their favorite beverages regardless of economic conditions. The margins on beverages are typically high because the products are mostly water with flavoring. The brand loyalty is intense. Household products companies sell necessities that people cannot do without. Laundry detergent, dish soap, cleaning supplies, paper products, the demand is constant because households need these products to function. The frequency of purchase creates regular cash flow for the companies. Personal care companies sell products embedded in daily routines: shampoo, body wash, deodorant, skincare, oral care. People continue their personal care routines regardless of the economy. The products are small individual purchases that do not require significant financial consideration. Now let me go deeper on utilities, because this sector has unique characteristics that investors should understand. The regulated monopoly structure of most utilities creates predictability that no other sector can match. Utilities operate under franchises granted by state and local governments. They are typically the only provider of electricity, gas, or water in their service territory. Customers cannot choose a competitor because there is no competitor. This captive customer base guarantees demand. The rate-setting process ensures reasonable returns on invested capital. Utilities file rate cases with state public utility commissions. They demonstrate their costs and their invested capital. The commission sets rates that allow the utility to recover costs plus earn a fair return, typically in the range of 9 to 11% on equity. This regulated return model produces predictable earnings. The essential nature of utility services means demand is almost completely inelastic. People do not voluntarily go without electricity or water to save money. They may conserve somewhat turning off lights or taking shorter showers, but the baseline demand remains substantial. The utility has guaranteed sales regardless of economic conditions. The capital-intensive nature of utilities creates barriers to entry. Building power plants, transmission lines, distribution networks, and water treatment facilities requires billions of dollars. A new competitor would need enormous capital and years of construction to challenge an incumbent utility. This capital intensity protects market positions. Let me explain the different types of utilities and their recession characteristics. Electric utilities are the largest category and benefit from growing demand for electricity. Despite efficiency improvements, electricity demand continues to grow as the economy electrifies. Electric vehicles, heat pumps, data centers, and other applications are driving increased electricity consumption. This growth, combined with recession resistance, makes electric utilities attractive. The energy transition is creating growth opportunities for electric utilities. Investments in renewable energy, battery storage, and grid modernization are expanding rate bases. Regulators are generally supportive of these investments because they achieve policy goals around carbon reduction. The growth in rate base drives growth in allowed earnings and dividends. Natural gas utilities benefit from the continued use of natural gas for heating and cooking. While there are long-term questions about the future of gas in a decarbonizing economy, the near-term demand is stable. Homes and buildings with gas infrastructure will continue using gas for years or decades. The utilities that serve them have stable revenues. Water utilities are perhaps the most essential and most stable of all. Water is literally necessary for life. The demand is absolutely non-negotiable. Water utilities typically operate as regulated monopolies with guaranteed returns. The growth in rate base comes from replacing aging infrastructure and meeting environmental requirements. This is about as recession-proof as any investment can be. Multi-utility companies that provide electricity, gas, and water benefit from diversification across utility types. If one service faces challenges, the others provide stability. The diversification also provides opportunities for efficiency by sharing corporate functions across multiple utility operations. Let me explain the dividend characteristics of utilities that make them attractive for income-seeking investors. Utilities have among the longest dividend track records of any sector. Many utilities have paid dividends for over a century. They have increased dividends for decades in a row. This track record reflects the stability of the regulated utility model and management commitment to returning capital to shareholders. The dividend yields on utilities are typically higher than the market average. Yields of 3 to 4% are common, and some utilities yield even more. This yield premium reflects the slower growth of utilities compared to the overall market, but it provides attractive income for investors who prioritize current cash flow. The payout ratios for utilities are typically in the 60 to 70% range. This is higher than many other sectors, but sustainable given the predictable earnings of regulated utilities. The regulated return model provides confidence that earnings will support the dividend. The dividend growth from utilities is typically modest, in the range of 3 to 5% annually. This reflects the regulated growth in rate base and the limited ability of utilities to grow faster than their service territories. But even modest dividend growth, compounded over decades, produces substantial income growth. Let me discuss how to build a portfolio with exposure to all three of these recession-resistant sectors. The simplest approach is to use sector-specific exchange, traded funds. Healthcare sector ETFs provide diversified exposure to pharmaceutical companies, medical device makers, and healthcare services companies. Consumer staples sector ETFs provide exposure to food, beverage, and household products companies. Utility sector ETFs provide exposure to electric, gas, and water utilities. This approach provides instant diversification within each sector at very low cost. An alternative approach is to select individual stocks within each sector. This allows you to concentrate in the specific companies you find most attractive while avoiding companies you find less attractive. The trade-off is that individual stock selection requires more research and monitoring, and concentrated positions create company-specific risk. A hybrid approach combines sector ETFs with select individual holdings. Use ETFs for broad sector exposure and complement them with individual stocks in companies where you have high conviction. This balances diversification with the ability to overweight your best ideas. The allocation across the three sectors can be equal weighted or tilted based on your views. Equal weighting, roughly 1/3 in each sector, provides balanced exposure. Tilting toward healthcare emphasizes growth potential from demographic tailwinds and innovation. Tilting toward utilities emphasizes income and stability. Tilting toward consumer staples emphasizes global brand franchises. Let me conclude with thoughts on why positioning for recessions matters even when the economy is currently strong. Recessions are certain to occur. The business cycle has not been repealed. Expansions eventually end. The question is not whether another recession will happen, but when, and because the timing is unpredictable, preparation must happen in advance. The time to buy recession-resistant stocks is before the recession arrives. Once a recession is underway and investors are panicking, defensive stocks will have already outperformed. The opportunity to position defensively at attractive prices is during periods of calm, not during periods of crisis. The cost of being prepared is modest. Defensive sectors may slightly underperform during strong bull markets, but the benefit of being prepared is substantial. Avoiding catastrophic losses during bear markets preserves capital and positions you for long-term success. Healthcare, consumer staples, and utilities are the only three sectors that consistently thrive during recessions. Essential demand, pricing power, strong balance sheets, and reliable dividends make them the foundation of recession-resistant investing. Build your exposure now while you still have the opportunity to position thoughtfully. Your future security depends on the decisions you make today. Make them wisely.